Pues inflación, desde luego, es una de las grandes incógnitas que tenemos de cara a la segunda mitad de 2023. Es verdad que hemos tenido un dato de inflación, bueno, pues que se podría considerar positivo, todavía una inflación elevada, 3%, algo lejos de ese objetivo del Banco Central de Estados Unidos, de la Reserva Federal. Y por cierto, nos vamos a ir hasta allí, hasta Estados Unidos. Me parece que ya tenemos a Jay Pelosky, TPW Advisory Founder. Jay, good afternoon.
Good afternoon.
Jay, CPI data today, we had CPI data that tops estimates in 3.0%, while core inflation is at 4.8%. The last time that we saw these numbers was back in 2021. Is this a turning point for you?
No, not really. We've been expecting this for some time and have been arguing that inflation was going to fall and would continue to fall. What's interesting is that so many people are positioned the other way. You have record short positions, for example, in the 10-year U.S. Treasury. You have record short positions, for example, in the Japanese yen, which is 50% undervalued versus the dollar, and yet you still have record short positions. So our view has been for probably the last 6 months that a Fed on hold, and we think the Fed is on hold, leads to a weaker dollar, and a weaker dollar means better pricing for commodities and for non-U.S. equities, and that's pretty much exactly what we're seeing playing out in markets today, and frankly over the last week or two.
Fed's path for this month's meeting?
I'm sorry, I couldn't hear all that.
Yeah, I was asking you if these figures that we got to know today in the CPI data, do you think that they're going to make the Federal Reserve change their minds in the next meeting this month?
Well, I don't know if they've made up their minds yet or not. The market has made up its mind, right? I think it was a 90% likelihood of a 25 basis point hike in the Fed meeting in a couple of weeks. To us, it doesn't really matter. We don't think they will raise rates. We think they are on hold, and rates will be higher for longer because we're not going to have a recession. So there's no real reason for rates to come down significantly. But if the Fed raises another 25 basis points in 2 weeks, I don't think it really matters because it's pretty clear that after that, they're going to go on hold because you have inflation running at 3% and you have Fed funds at over 5%. That means you have 2% real short-term rates, which is way higher than real short-term rates have been for a considerable period of time, probably going back to pre-Great Financial Crisis periods of time. So the Fed is pretty tight right here. Inflation is coming down. The economy is doing fine. And that's why stocks are continuing to do well and risk assets are continuing to do well.
Today, by the way, Jay, we spoke here in Negocios Televisión about the fact that 25% of CPI is owner's equivalent rent, which is a survey that asks homeowners to say which price they think they can rent their house. Basically, this means that imaginary rents account for 25% of CPI. Jay, without housing, core services CPI would be 4% instead of the 4.8% that we saw today in core prices. Do you think that we should really worry about the fact that data about housing or about rents may be manipulating CPI?
Well, I mean, you can torture data any way you want, and you can make data kind of tell you whatever you want to know, right? I mean, that's why people are still talking about a recession. It's been a year since recession was consensus, and there's no sign of recession. Q2 GDP, according to the Atlanta Fed nowcast, is running over 2%. So we're far, far from a recession. So data can always be kind of can be used to tell any kind of story. I think the way we're looking at it here at TPW Advisory is that rents are coming down. They're coming down sharply. They're actually negative now year over year on average. And so the CPI collection process runs with a lag. And so that lower shelter inflation, which is also going to be created because we have record multifamily construction going on. In other words, we're going to have a lot of new rental apartments across the country. We're at record levels of multifamily construction. So the outlook going forward is very constructive for rents to come down. And that's another reason why our view is that inflation will continue to moderate. We think more towards like the current level. I guess now we're at 3%, because we don't think the Fed is going to damage the economy to get the inflation number to 2%. We think inflation is going to kind of settle between 2 and 3%, and that's going to be fine for the Fed. They're not going to change their target, but they're going to allow inflation to kind of moderate in between 2 and 3%, and that's going to be a great environment for growth and for risk assets, because we're not going back to the 2010-2020 period of low inflation and low growth. We're moving into a higher growth period of time, driven by the new industrial policy of Bidenomics, of reshoring, of climate, of fighting climate change. There are a number of big positive differences between where we're going and where we've been that lead us to think inflation is going to be, as I say, between 2 and 3%. And that's one of the reasons why we've been so constructive on cyclical sectors like transports, like home builders, like industrials.
Very interesting point, Jay. Jay Pelosky, TPW Advisory Founder, as always, thank you so much. Have a good day.
Thank you. Have a great day.
Bueno, pues nos